Hey there. Thank you for watching the first four sessions. And I believe you would have definitely gotten an opportunity to download the templates and work using those templates. I thought of let me just have a working session which can actually explain to you how the templates actually work. So far, we have seen revenue, profits, cash flow statement. We've seen balance sheet, right? So let me take you through two important, sheets that I've made. The first one, when you are starting your venture, when you're doing a startup, there has to be one sheet which I call it as a financial planner. Okay. So this particular sheet that you see, T0, this, and you can take this as a template. This is the starter financial planner. Okay. Now, how do we start with? It's very simple, right? The first thing is the first tab that I've created here is the capital sources. Where is the money coming from? Okay. All the blue numbers that you actually see are the input values which you can actually give. Okay. And these red values that you actually see here use formula, Excel formula, and these are very simple formula. We've already seen those. So let's see this. So what we have done is, right, on the first row, we've created the startup financial planner, and you can call your startup name as well here. You can mention your startup name as well, right? And then you can come directly to the next row. The first column is source of capital. Okay, what is the source of capital? Where is the money coming from, right? What will be that amount? And of course, you do mention on the top rupees, because we're taking the Indian context. But if you're from a different country, you can use that currency as well. Then second important thing is, what kind of money is this? What kind of amount is this, right? Is it an equity? Is it something that you have taken as a loan, maybe a debt from a bank of friends and family, right? And you know, from an investor. If you've taken from an investor, it could be an equity, obviously, government grants, right? Or there's a bootstrap revenue. Okay. These have differences, and I'll tell you what these differences are. So you can actually mention this, right? It'll always be a good practice for you to understand, because your CA or you can actually understand what kind of value is going into which cell. Then we have created a deliberate column for the interest rate. Of course, every amount will not have an interest rate. So, for example, if you have taken some money as a loan, right, from your friends and family, right, here, your let's say your parents would have given you money, and obviously they're your parents, right, or very good friends. They don't want any interest. They just want if you can just repay them, right? So there's no interest here. Okay. Or sometimes it is non-repayable also, because here we have mentioned non-repayable. So let's assume that. Okay, I'm just explaining right now. Then comes the loan, the formal loan, right? From a bank, it is at 12%, let's say, right? Or it is, if it is from NBFC, it could be like 18% or 21%, whatever, right? And here you have got some friends, family outside, and because they're helping you, right, you are giving them an interest of 6%. So just mention that. Okay. Now, the moment you have this interest, right, you definitely need to pay them. When are you going to pay them? And how are you going to pay them? Of course, in the form of EMIs, equated monthly installments. Okay. So, what is that repayment period? So, in terms of months, let's mention. Okay. So, these are the values that we have mentioned here. Then we have created another column where what will be that repayment value, that repayment amount. Okay, this is what it is. So this is that EMI value that you actually see. And there's another section which, if you want, it's always good, the notes. What are you actually doing, right? So uh, from row number 3 to row number 12, what you see clearly defines your source of capital. Where's your money coming from? And then you can do a total, which is row number 14. Hope this is clear, right? Then at the end, we will have another section called the capital structure summary, right? This total capital which you have raised is what exactly? What is the split? How much percentage is equity? How much percentage is debt? How much percentage is, so you have to actually do this, right? And then you can calculate something called debt to equity ratio. So it's always better you split into two parts. How much is the equity capital and how much is the debt capital? Okay. And put the percentage here. Okay. And you can mention the notes here, right? So this is good. So this is the first tab. The second tab is the startup cost. This is the one-time cost, one-time setup cost. Let's say you're starting a restaurant, right? Your customer will only come once you have everything ready. The chef is there, the restaurant is actually ready, the opening has already been done, the food has been prepared, and people are coming and ordering, and you're, fulfilling that order. Right. But there's a lot of work that you do prior to opening a restaurant. Okay. And that incurs a lot of cost. That is called the startup cost, one time cost. It could be legal, registration, technology, right? Inventory, miscellaneous, all these things. Okay. So this is where we will actually, capture. There's an office and infrastructure cost as well. The next one is that we will do is the monthly burn and runway. Okay, when we're talking about the monthly burn and runway, it's very simple, right? And this will help you to actually understand how much money you are left with to survive, or after how much money, I mean, if the entire money goes away, right, what will happen to your business? Okay, so how long can you sustain? How long does your money last? This is the most important number before you launch. Okay, so there are certain sections we have created here as well. Section A talks about your starting cash position. So starting cash position is usually, once the startup cost is subtracted from the entire, money that you already have or you have been promised to have it, right? Then there's another section which actually talks about the monthly, fixed costs. It could be all the expenses that we have actually seen, and these are by and large the fixed amount, right? And this will help you calculate your contribution margin if you remember the last session that we had. Then comes the revenue ramp. Okay. Right. And here is a simple metric that we have done where how much is your expected revenue? What will be the variable costs? What will be your gross profit? So in one snapshot, you can have a picture. And then there's another section which calculates your runway. Okay. And then the section E is all about your cash position. It's a changing of your cash position. You can call it as a cash flow statement as well. But this does not incorporate those three sections of the cash flow statement. So this is not exactly the cash flow statement, but still it is going to tell you your cash position overall, view month on month. Okay. So this is a waterfall view that you actually see. And then it's always good to have a dashboard. Okay. What's the total capital or funding that you have? Okay. What is the startup cost? Right. And then the cash position, and then there's the runway, and then there's the financial health check. Okay, so very simple. So there's some formula that we have actually created. Runway is at least 6 months or not, and you will always get an answer. Yes, it's self-sustaining. I do have. So you can do all these, with Excel. Debt is less than 50% of the capital. Yes or no. If it is yes, equity heavy, this is good, right? Monthly fixed costs below 30% of the target. Okay. So it is in review section, costs high versus target. Okay. One time costs, which is less than 25% of the capital raised. Right. So we have mentioned all these things. We'll see. So this is the one template. The second template is this template, which is actually the monthly, P&L tracker. Okay. So let's do some configuration. Let's talk about our business. So you can put the name of your business, right? Your financial year, month. Let's say if you're in India, of course, your first month will always be the month of April. So it's month 4. Likewise, so all these things you can actually do, while the calculations that we are going to present here will start from January to December. right? We will track all that. Uh, and if we have started our operations from 4th, which means January, February, March will all be zero in most cases. Okay. Then we have mentioned the pricing, certain fixed amounts, because you can actually use these in your connecting sheets. For example, if you may recall, um, Aryan's business study AI price per download is 99. There's a deliberate section that I've included to make him more profitable, or there's another variant or offering, which is price per tutoring session. So he's actually trying to connect a lot of tutors with the students, and those tutors are charging 499 rupees maybe for an hour or so. Okay, so that's how it is, or monthly. Okay, but that is not very specific, but let's call it as per tutoring session is 499. It's as simple as that. Okay, so in a month you can have as many tutoring session. Payment gateway, as usual, we mentioned 2%. Then there's a cost structure. Okay, variable hosting 2%. So you can actually see all these things, and then towards the end you have the taxes. Okay, coming to the monthly P&L, this is how the monthly P&L looks like, right? You may recall your inputs. So the top line, which will calculate your revenue, then you have the COGS, cost of goods sold. You subtract from that, you get the total COGS, gross profit. When you subtract the total COGS from the revenue, then you have the OPEX, the operating expenses. Okay. And then you have EBITDA, you have EBIT, you have EBT or PBT, profit before tax, and then the net take home, what you call the net profit. Okay. And there are some ratios through which you can actually decide what's happening. Okay. What to increase, what to reduce, likewise. And there's an instruction that's actually mentioned how to use this template. Okay, so for example, there's some color coding. Blue text usually are the input cells. The black texts are the formula ones. The green texts in this particular sheet are linked from another sheet, so don't overwrite. And the yellow ones, key assumption cells that need your attention, so you may actually take into account. And then the formula, which we have already done that. Okay, so let's go line by line. I'm coming back to my start of financial planning summary. Okay, let's do something amazing. And I will come back to the capital sources. Okay, sources. First one is source of capital. The personal savings, the founder one has used, and he's investing 5 lakh rupees. Okay, so because he's investing, this kind of money is equity. You own that money. There's no repayment. If you have another founder, and if that founder also invests, obviously it will come, but there's no another founder's a co-founder contribution. You can increase the number of rows if you want. You can insert. Okay, let's try to raise some capital from outside. Okay, near and dear ones, friends and family, maybe fools as well. Okay, FFF, yes, friends, family, and fools. Okay, so some of you may get a gift from your parents, your near and dear ones. There's also an equity, but this is repayable, and you have to just document with a letter. That's it, nothing else. Okay, friends and family, in form of loan. Of course, if it is loan, so this is a debt, and this is at 6% for 2 years, 24 months. And this is where you calculate the monthly repayment. So this section, what you see, let me just expand it, is the monthly repayment. Okay, how do you calculate it? It's very simple. You know the formula, but there's a standard function in Excel which you can use called the payment, PMT. And what it does is it takes the 3 inputs, very simple. The first input is it calculates the rate of interest. Okay, so here you see D7 by 12, because so D7 is this 6%, and this is entirely for 1 year. Okay, now because PMT is calculating for 24 months, okay, which means for every month we are actually calculating, we have to divide D7 by 12. Okay, that's one. Put a comma, then how many months, the time period, that is 24. So that will actually come here. And then you have something called B7, which is on what amount, what principal amount, that is 2 lakh rupees. Okay. Now you have a question, why there's a negative sign? The negative sign is very simple here because this money is going out. Okay. This is what you are actually paying. And you know that there will be two parts to it when you pay the EMI. One is the principal, second one is the interest. The interest will be recorded on the profit and loss, while the principal will be recorded in your cash flow statement. Okay. So the amount that you calculate here, that you see here, is 8864. This is the EMI. Okay. And you don't have to necessarily use another function called the if error. The if error is only going to tell you whether this is calculable or not. If it is giving the right calculation, it is there. You do, otherwise you give a value 0. So that's why I deliberately put it. But otherwise, if you want, you can actually remove this. Okay. This is an informal kind of loan. The agreements are maybe, just oral and on good terms. That's it. Okay. Let's have a formal loan. Right. MSME loan, medium and small scale enterprise loan, 5 lakh rupees. This is from a bank, 12%, 36 month, 3 years, and the same formula. D8 by D12, E8, comma, minus B8. Very simple. So 16,607. Please remember, this is the EMI. This contains your principal and interest. Okay. Then from an NBFC also, you may take that, but here there's nothing. Usually it's 18%, 21%. You check their websites, but there's nothing. Okay. There could be an angel investor, right, giving you, but angel investors' money will be in the form of equity. Why I have already added this so that it can become easier for you and you just need to, record the values. Okay. I will not say this is 100%, but by and large, it will suffice, right? Then government grants. Sometimes what happens is you raise the money and there are a lot of government schemes. Okay, there are a lot of yojanas, particularly in India. If you do your startup, get registered in the DPIIT, right? You'll get a lot of benefits. Okay, and that amount that you get in the form of grant, the good thing is you don't have to pay that back. There are no interest, nothing. It's your money. All you have to do is use that reasonably well. That's one. Use it only for your product development as long as possible. And time to time, keep, informing the government, keep giving them updates how this is happening. So this is a grant, non-repayable, milestone linked. Okay. So you can explore about grants as well. Then comes the bootstrapped revenue. You might have heard certain startups. For example, Zerodha is a very famous startup, right? And it's a bootstrapped one. What do you mean by bootstrapped? Which means that they did not raise capital. Okay, so sales from day one, and you generated that revenue, right? And putting that revenue, after subtracting all the things, I mean, right, whatever you're left, maybe the profit you're putting back to the startup. Okay, but you're not taking external funds. What's the good story about it is you don't have you don't have investors. Okay, it's your money. You're there on the cap table. We'll discuss about cap table a little later, maybe towards the end, but that's what it is. You don't have to dilute your business. Okay, so more decision power for you. Good. But this is, again, this kind of revenue is a revenue. Okay. Bootstrap revenue is revenue. It's not at all an equity, not at all that, because you're not raising it from anybody else. It's your own money. That's the reason we have mentioned sales from day one, funding operations. If you total this, okay, you will get something like this. Let me just see whether this is correct. B4 to B12, correct. So this is what is the amount. Okay. So how much it is? It is one. Yeah, it is correct. So this is 15 lakh rupees, the total money available. Okay. And out of this total money available, the EMIs are 25,471. Good. Now to this 15 lakh rupees, okay, if you see the equity capital, which are these two, this one and this one, 5 lakh and 3 lakh, 8 lakh rupees, which is 53%, 8 lakh divided by 15 lakh rupees, 53.3%. Okay, very simple. And similarly, the remaining amount, which is 7 lakh, is 46.7%, is the debt. Why do you need to have this kind of structure? I mean, 15 lakh rupees is what we got, but you need to understand how you've raised. Okay. Imagine if the debt capital goes very high. Okay. Everything is debt. There's a big loan that you've taken from bank and you're running your business. Think about it. So because of which we calculate something called debt to equity ratio, and this value has to be always less than 1. Here it's 0.9. Okay, below 1%, it's equity funded. But if it is above 2x, 2 times, it's a heavily leveraged. Okay, so this is still good. Okay, let's see. Let's move on to the startup cost, the one-time cost. Okay, so some assumptions also we have taken here. So let's see. Uh, the first section under the cost item is the legal registration. Why legal registrations are important? Because you want to give an identity to your venture. You want to protect the venture, right? You want it to be recognized as unique. That's very important. Okay. If somebody else wants to start a similar startup, and with an identical name or identical logo, you can go and claim, right? You can file a lawsuit against that person. So there has to be some kind of protection, the legal, the trademark registrations. Okay. So everything you need to do for that, some amount will be invested. Okay. Let's see what are these. One is the company registration when you're doing a private limited company. But if you're doing an Udyam registration, it does not require any money, right? But when you're doing a company registration, and of course, you're very new, you don't know about it, maybe you can take the help of, people who understand this, right? Some CAs or anybody. So there could be a cost from between, 5 to 10,000 rupees, sometimes more as well. It depends. Okay. And so MCA stands for Ministry of Corporate Affairs. So 7,000 rupees is what you have assumed that will go. And this is an expense. This is an expense. This is not at all an asset. GST registration, of course, right? And it does not require anything unless you have taken a professional help. If you're doing it by yourself, trust me, it's very simple. There are technicalities, so it may take a day or two time for you to learn that and put it. But I will suggest that do it yourself, right? And so that you will actually learn as well. Okay. The GST officer may call you, come back, visit your location, and then issue the GST. That's it. So this is also an expense because this, right? Next one is the trade registration, trademark registration. So it's very important. Sometimes you must have seen with various logos of companies or startups, you find TM mentioned, trademark, which means that the logo is not yet registered. It's under process, but nobody else can actually claim that. It takes some 4 to 5 months sometimes, and there's a nominal fee that actually goes 5,000 rupees, right? So why do we need to do that? It protects your brand, and this is an asset because you can actually amortize this, and the useful lifetime is 10 years. Okay, very simple. So 5,000 divided by 10 is 500. And if you have to do it monthly because you're going to put it in your PNL, it will be 42 rupees, 41.6 rupees something. Then comes the legal agreements, the founders or the NDA, that is non-disclosure agreement. We'll talk about that. Okay. Uh, so, for example, there are two founders and you really want to be assured that both the founders, work cohesively, they listen to each other, they agree to disagree, right? They work properly, the time management is done properly. So there are certain bylaws that you create. It's called founders agreement. Likewise, there's certain confidential thing which you sign, and you can get it signed, uh, right, for your employees as well, right? Employees sign that saying, the non-disclosure agreements. Okay, so takes time, takes money, right? and 5,000 rupees. You can get it created today. You can use ChatGPT or any other AI tool and just see how that actually works. Okay. So CA lawyer fees for standard docs. Professional fee, CA for the setup, that is 5,000 rupees. It could be bookkeeping, getting your TAN, PAN, all that. But if you're smart enough, or you can actually go and read things, right, maybe you can save a lot of money. Okay. So 22,000 rupees is that one time cost that's gone. Then comes the technology and product. Any startup, a startup is a startup probably because it requires innovation, innovation in the product, innovation in the process. Okay. And technology is that one tool with which you can actually do it. And for that, you require certain setup. You require a laptop, a computer, right? Anything. I mean, software, so many other things. Okay, machinery, right? And that's where the money will go. So let's say you purchased a laptop, and here we're putting 60,000 rupees. And of course, as we mentioned, that this becomes an asset, and this will create a value, of course, for you. Okay, but it will also depreciate over a period of time. Let's say the maximum life, useful life is 5 years. So, very simple. This 1,000 rupees is what we have kept. Okay, per month depreciation. Perfect. Like a second laptop for the co founder, we don't have mobile, we don't tablet, maybe we don't have. We don't require website development. Yes, 15,000 rupees one time, 3 years. So 417 rupees is what you can amortize. And this is an asset, so you can capitalize it. Okay. The next, uh, app software development. Today, you may not require that much money to develop a software because a lot of tools, with the help of AI, you can actually do that. Right. But if you're good enough, it's always good that you should know coding sometimes if you're developing. Good for you. Okay. But you can take a professional help and they will charge you some amount. Here we have assumed that it's not that required because the it's a simple app. Then domain name annual 1,500, and this definitely requires. You can go to GoDaddy or hosting anywhere, right? I'm not here to endorse any brand here, but I'm just trying to say that you can actually go ahead and purchase from anywhere. So 1,500 rupees is what you'll get. This is an expense, okay? Annual expense, and it's not a depreciable amount. Then, software as a service, tool setup, which is 10,000 rupees. This is also again expenses. You can buy so many other software, external software, not depreciated. Then, server and hosting setup. This is an asset. So it could be hardware only, particularly. Monthly hosting can be there. So currently, it's not required for this startup. Okay. The total technology cost is 86,500. Okay, which is again B13 to B20. So we have used the sum formula. Okay, fine. And if you total, your depreciation value is 1,417. Then comes the office and infrastructure. Okay, so you need to have an office space sometimes. Okay, and they take some security deposit for co-working space, whatever. So 30,000 rupees, let's assume. Depends on which city you are and which place you are and what's the area, right? This is a refundable amount, and it stays as an asset. Okay. Then you have to do a makeover of the office, add some furnitures, do some fit outs, 50,000 rupees. And if you're buying a furniture, let's say 7 years the useful time, and per month 595 rupees would be the depreciation. Then comes the office equipment, ACs, printers. Okay, so far there's nothing, right? We have excluded some initial stationery, maybe for 2,000 rupees. We need to buy papers, pens, stamps, many other things, right? Small amounts. These are expenses. So 82,000 rupees goes into that. Then comes the branding and marketing section. Very important, very essential. Logo and brand design. Maybe you've given it to professional and they've done it. And it's always good to have a professional, designing this. But today you can use Canva, you can use many other tools. You can use, Gemini, Nano Banana. There are a lot. They can actually help you at least. But you may not get a very professional, clear picture, high definition. So you should know at what angle the particular letter is inclined. You can take some inspiration from these and design your own. This may cost. Okay. Okay. So this is an expense. Business cards and print materials. Of course, I think it's very hard for you to print it at home for yourself. Despite you have a printer, it's always better go outside, get it printed. There are a lot of companies which are actually startups which are doing this. Maybe I think the value that I know, it can start from 200 250 rupees for 100 cards to it can go as long as how, depending on the quality and the effort that has gone into making it. Okay, initial ad budget. This is important, 20,000 rupees, and this you will require. Okay, many startup there are many startups today. They use just organically, but it's always good to have the launch campaign. Um, Set aside a marketing budget. Okay, this is not an asset, it's an expense. Photography or product shoots, whether it's digital, whether it's on e-commerce, physical, sometimes you require. Right. In case of this, I don't think it's required. Branding and marketing total cost is 32,000 rupees. Then there's inventory in stock. This is particularly for the physical, products inventory. Okay. So initial raw material and stock. This is the asset and appears as an inventory on the balance sheet. Packaging materials. This is an expense and there's a variable cost that actually goes. But currently we don't have this. Okay. There are some miscellaneous. It could be insurance premium. It's an expense. Then pre-launch travel meetings. Just budget that. There could be some other one-time petty cash expenses. Total 10,000 rupees. So the total one-time cost is B10, B21, 28, 30, 46. So let's see. So this is 46. This is 35. This is 28. This is 86. Yes. This one is then 10. Yeah. When you add all these cells, you get 2,32,500. So from the 15 lakh rupees, this is that one amount which will go immediately. You have not made a single penny, not even started. Okay. And of which, let's have the split. One time expenses, okay, reduce profit immediately, 72,500. And that that's going to go to the balance sheet. Depreciated monthly is 1,60,000 rupees. Okay, so very simple. So it's all about what is the asset and what are the other expenses. Just calculate this. So these are the expenses, very simple, and these are the assets. You can see I've used the formula as well. Okay, now 2,054 is the depreciation value. This is this recurring monthly depreciation, right, flows into your P&L every month. So hope this is clear. We'll move on to the monthly, burn and run away. This is also important. We've already discussed how much is the money that you should have before you bankrupt, for the lack of better word, I'll say. So your starting cash position is 15 lakh, right? One time cost, a setup cost, where was 2,32,000. You're left with 1 lakh, uh, yeah, 12,67,500 rupees. Right. This is the starting cash, is a bank balance on day one. All you have is this much. Okay. Then let's discuss the monthly fixed cost. Founder salary, if it is, if right. If it is not, there's no co-founder here. If there are employees, initially maybe a one-person team or two persons at max. Yeah, but there's an office rent that's going 5,000 rupees. As for software and other subscriptions, 800 rupees. Internet, 1,500. Phone, 500. Professional fees, 1,000. These are the fixed ones. Insurance, 417. This is monthly, by the way. Loan repayments, 500 rupees. And this we have calculated using our previous, this these two values. Okay. So, yes. And then Um, and by the way, what is this 500? This is the interest amount. Please remember, this is the interest amount. Okay. And then the loan repayments or the bank NBFC loan 2500. Marketing ads, this is what we are planning. So 4,200. There's a depreciation from the other sheet that we actually saw, 2054. So total fixed cost is 18,471. This will always be there. Okay. So the C section, which is the revenue ramp, okay. Let's have the expected revenue. So month one, there's no. Month two, no. Month three, no. Month four, we're expecting 5,000 rupees. Month five, and likewise, by the time we reach towards the end, we want 30,000, 1,30,000. Overall, the revenue would be 5,20,000 for the entire. This is what we are expecting, and the variable costs would go from 200 to 20,800. So the gross profit will start from 4,800 to 4,99,000, nearly 96%. Good business. This is what we've taken an assumption. We're just trying to be conservative at the beginning, not to overestimate early revenue as 3 to 5 times. Okay. Then the runway calculator, very simple. So starting cash position is this much. Okay. This is pulled from section A above, total money, that fixed cost, that's the burn rate. We know that average monthly, gross profit is this much, right? And net monthly burn is 23,129. Okay, very simple. So this is B35, this one, and minus B36. Okay. And because this is in brackets, so obviously it's negative, right? So the runway is self-sustaining, right? And are we out of cash? Currently not. Let's do a month by month, cash position. We start. So our opening balance is 12,67,500. No revenue, no variable cost. There's only fixed costs, loan repayments, net cash. So the closing balance for that month will be 122. So what are we doing in that 1 month? Obviously, we'll be going out, meeting people, doing a lot of marketing, trying to have, leads getting converted for our next month or so. Okay. With a lot of efforts, we couldn't do. We have only burnt our money. So from 12,26,558, we are now left with 11,44,674. But by this time, we have developed a lot of pipeline and we are seeing a boom. First revenue, 5,000 rupees. Okay. 200. So this is an assumption that we have taken from here. Okay. This is just to tell you how this works. You have to put your actuals. Okay. And you can now see how this is moving. Right? And what is happening? Your closing cash is actually reducing. But from here, this month 9, your closing cash is actually increased. Why? Because if you see, one thing is fixed, that is the fixed cost. The good thing is your revenue has increased from 5,000 to 70,000. Okay. And if you look at the net cash, which is flow this month, was also higher, that is 26,258. So you're left with this. Then you're actually increasing, and by the time it's month 12, you're left with 12,75,000 rupees. Okay. I hope this is clear. We'll move to the summary dashboard. So this is the summary of the entire thing that we've created. First section is capital and funding, 15 lakh. Equity capital, 8 lakh. Debt capital is this, 0.9 debt to equity ratio. Monthly loan repayments is this much. Startup cost have not yet put, but you can actually put it from the table. Cash position, 1,267,500. Right, this is clear. Then comes the runway. Okay, some questions. Self-sustaining, no cash burnout, already profitable. And these are the 4 questions. For most, it is good. We're done with this template. Let's move on to, creating this P&L statement. Okay, let's start with the first tab. Let's do some of the configuration. We've already seen name of our business. Just put your name. Here we are taking the example of Study AI. Some numbers from the previous sessions may change, but this will still give you a full picture. So don't worry. Financial, year start month is 4. Currency rupees is right. Then pricing is 99. Tutoring section, this one more offering that I've included is 499. Okay. Right. Now, how does this tutoring work in under the cost section? So the tutor payout is 60% of the revenue. Okay. So for every 499, the 60% will go to the tutor, which means that this is directly linked with revenue. Okay. Then content amortization, 1,000 rupees. We've taken this is fixed. Then there's a writer salary. Okay, 8,000 rupees every month. These are all fixed. Marketing budget 4,000, CA 1,000, office 5,000. There's a depreciation of 833 per month, and some taxes, which is your income tax. Let's assume 25%, and GST is 18%. Okay. Now, this is the P&L, the monthly P&L. Let me just zoom in. Right. So the blue items are inputs, the black, the formula, and update downloads and sessions each month, every for yourself. Okay. Let's start with January. While I said that we will do it April, so this April could be the new month, but here uh, it's always a good practice to start from January to March. You may start from April to then go ahead. It's up to you. Let's assume it's Jan, 200 downloads. Tutoring session was not there, and until March. Okay, total revenue 19,800, because 99 rupees is the price. For tutoring, there's nothing. And this is one thing that I deliberately introduced called the refunds. Okay, and this needs to be subtracted. Now, what do you mean by that? So sometimes what happens, you're doing people are paying you, but not all payments are successful. Okay, and so there's some charge that gets deducted. So therefore, these are those refunds. Let's assume this is at 0.2% of the entire revenue. So here you have lost 40 rupees. Net revenue is 19,760. Okay, very simple. Then again, cost of goods sold, we've already discussed. Content amortization, it is 1,000. Hosting downloads, 400, because I think rupees 2 was there. So 2 multiplied by this 200. Okay. Please remember these brackets, the values in brackets are all negative. Okay. All negative numbers. They are subtracted. Okay. Tutor payout, there's nothing. Payment gateway, 2% of the revenue, 395. Total COGS. How do you calculate COGS? This minus this amount. But this is already negative. So obviously you have to add it. Okay. Right? So this one and this one. If you add both, you will get 17,009, which is 90.9%. Okay. How do you calculate it? You take this gross profit, divide it by 19,760 and multiply it by 100. Okay. Very simple. And likewise, you can do for the entire year, right? Towards the end, if you see, it's 88.8%. Let's do now the operating expenses: writer's salary, marketing, software, domain and hosting, professional fees, office, and there's a depreciation, 833, which I'm adding here, but my total OPEX will not include this because I have to calculate something called the earnings before TDA. Okay, so I'm just keeping it here, but I'm not doing. So I'm getting 19,500. Okay, if I subtract 833 from this, I will get that 18,700, that particular value.
It's 5 o'clock.
Okay, so this what you get. Now let's calculate the earnings before taxes, before interest, taxes, depreciation, and amortization. And this is that amount. Very simple. And this is negative. Okay, because you're subtracting this particular amount 1950, which is higher than your gross profit. So obviously this will be negative. So you're left with 1,532 negative number. So EBITDA is negative currently 7.8%. Now if you subtract the depreciation is already negative. So obviously you have to add. So your EBIT is 2368. Remember, this is a negative number. For many of you, there could be confusion. I'll take a positive number. Let's move to the second month. In the second month, the OPEX is fixed. Okay. But if you look at the gross profit, it was 25,055. So if you subtract this value, you get it 6051 positive. If you remove the depreciation 833, you get 5218. I hope this is clear. Then let's remove the interest, which is 500. You get 2868 negative, and here it is positive. Okay. There's no income tax here. There will be here, and 1180, and you get the net profit, right? 3539. For the first month, it is negative. So from minus 14.5% to 12.8%. This is where from month 1 to month 2, you've already achieved the break even. Hope this is clear. Continue this entire thing till the end, and your net profit, the take home is 46.1%. You're making the overall revenue of 9 lakh 10,000 rupees, gross profit of 1 lakh 1,570, right? So sorry, yeah, this particular value is the COGS. So your gross profit is 8 lakh 8,629, 88.8%, and your OPEX was 2 lakh 34,000. So if you subtract this amount from here, you don't have to subtract, please remember you have to add, and because it's already a negative number. You may ask a question, why not I have all these numbers written in positive and I actually do a simple math? You're right, actually. First reason is if you look at the entire financial sheet legally everywhere, this is how it's presented. And there's a reason to it. One reason is if you look at this, you can actually very clearly differentiate between the positive numbers and the negative numbers. And we don't put a negative sign because it doesn't look, and in Excel sheet, it's hard to then do the math. It's always better to put in brackets or parentheses. So you can actually see the parentheses. What if all the numbers were same? There were no positive and negative sign. It would have been harder for us to differentiate between these numbers. So that's the reason. Anyway, let's come back. Yeah, so we got 63.1%, the so this was operating expenses. So this will be yes of EBITDA. And then we subtract further this depreciation, right? And towards the end, we get the net profit. Okay. So from EBITDA to EBIT to EBT, which is PBT, profit before tax, and we get profit after tax. Once you're cleared of everything, you have paid to everywhere, this is the final amount, 4,20,058, and you can distribute it depending on the equity share that you have. Okay. So what are the ratios that are used? One is the gross profit margin, which is gross profit divided by revenue. And you see it's so high, right? Close to 90% maintained throughout. Please remember, in most businesses, gross profit is something that usually doesn't change. It remains constant. It should always be higher. We've already discussed from industry to industry. Look at the EBITDA margin, EBITDA by net revenue. Okay, from negative percentage to a positive one, right? And net margin percentage, we've already seen from minus 14 to 46.1. This is great. It's a great figure. And then there's a month-on-month revenue growth you can calculate. So first month, of course, you can't do because the formula is very simple. You have to take the present month minus the last month divided by the last month, right? And into 100. So we can do only from the second month onwards, and we have to stop it here at December. Similarly, operating expense as a percentage of revenue. This is important. This will help you what to reduce. Okay. So look at the first month. Very high operating expense. Very high. And you, as an entrepreneur, should take some informed decisions. Keep reducing it, keep reducing it. Okay. Here it shows zero, but ideally it won't be zero, but try to always keep it very less. Okay. So hope you enjoyed this. Thank you very much. And